Hi, I'm Mark Honeybone from Property Ventures, and welcome to our weekly podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. This is a free service from Property Ventures so that you can keep current and learn from some of the best around New Zealand. To check us out, take a look at propertyventures.co.nz. We hope you enjoyed today's podcast. Hello and welcome back to part 2 of the show where Philip Macalister from the Property Investor magazine shares all. In the second part we talk more in depth of different strategies of investing and the property market. We hope you enjoy the show.
That's a good way to keep people up to date with what's happening and hear other people's stories. So, we continue to learn about Facebook, like everyone. Oh, excuse me. Like everyone does, yeah.
That's good. Hey, just interestingly enough, going back, actually, you've been involved with the magazines for a wee while. Thinking of how the housing market going through the whole cycle, sort of like from from mid 2000s to near the late when we got to the highest point of the market, and then the downturn after that. I'm just interested to know, how did the magazines rates or sales go during that time? Did that follow the no as in people buying them went down, or just interested to hear how that went?
Look, definitely. There's no doubt that the magazines and the websites to some degree, but the whole business, they're intricately linked into the cycles, and so when we went through the bottom of the housing market cycle, they were pretty tough times. I mean, sales, readership did go down, but they're certainly growing strongly at the moment. And also there are a few people who were wanting to advertise, and a lot of the contracts we had, they stopped. And so 2 or 3 years later, you sort of have to go back and try to get those people back on board again. The thing I take the most pleasure out of is that we went through the cycle. We went through the bottom of the cycle, and the magazine, we still had a good readership audience out there, and it is, we'd probably say it's the biggest business magazine in New Zealand these days. We went through the bottom of the cycle, but we still had a good readership numbers, and we still had good revenue in the magazine, and it actually remained profitable through the bottom of the cycle. So I sit there and I say, well, hey, if that's as bad as it gets and we come out the other side, we've done pretty well. A lot of publishers have disappeared over recent years because they've just found it too hard. So I think that's sort of been, if I give myself a little pat on the back, me and my team here, we did well to get through that. And I think when we look into the publishing world, and we have a business here which is, totally tied into financial services and what's happening in personal finance world, and we go through both a housing downturn and the global financial crisis, and yet we come out the other side okay. The bank hasn't taken my house off me yet. That's actually been a really satisfying event or time for us, but it certainly was hard. It's still not easy. It's not as good as it's not as good as it was and this time in the cycle previously, but we certainly think things are turning around, and there is a lot of good news out there in the economy at the moment, and people are becoming more active. But I also think, and it's actually going to be something we're doing in the July issue of the magazine, I think the whole property market is going, and we're going through the same cycle as we always do, but this upcycle is very, very different to the last one. And the proposition we're exploring at the moment is that this cycle is actually safer for investors than the previous cycle was. And it's safer because of things like, the banks are being a bit more cautious with their lending. The Reserve Bank's obviously playing a pretty important role in that. The government's sort of taken away some of the benefits and those sorts of things. And investors, I think, are not... I think they're a lot more professional and they're a lot more mature in their approach to property investment than maybe some of the participants were in the last cycle.
Yeah, totally agree with that. And and they're a little bit mature, whether it's maturity or cautious or what it is. I definitely see that, and it is a different cycle. I get asked quite often myself, where do you sort of see the cycle or where it goes? There's a lot of factors, I think, why it's not going to have a crash all of a sudden, especially in the likes of Auckland or what have you. Some people go, there's going to be a crash. I put the cycle, personally myself, into various parts around the country. I'm not sure how you feel about that, but there are still. I don't think it's going to be a rocket up, 150% like it each year for about 3 years, like it did back in '07 and '08. But these factors there, I think, at the moment, just holding it that it will. Whether it's not going to be as severely going up as it was last time, but because of that, I don't think it's going to be severe coming down either.
Yeah, look, I think you're absolutely right again there, and it is, the cycle probably won't get as toppy as it did last time, but then the downside won't be so ugly either. I think you see that, one of the other examples I use in my thesis that this cycle is safer is that, interest rates aren't going to go as high this time round as they did last time. I mean, last time we had floating rates in the double digits. We had 10, 11% floating rates. This time they're probably only going to get up to 8 or 9%. So it sort of reduces some of the risks in there, and also I think people are being much more prudent around their debt levels within their portfolios. I mean, one of the things which I often talk about to the other media is, if you take property investors and you look at their portfolios as a whole, the the large majority of property investors have debt ratios of below 60% in their portfolios. They're safe and they're prudent and they're actually paying down debt. They're not all highly leveraged with 80-90% LVRs, and they're not sitting there in situations where if there is a shock like a big rise in interest rates or a loss of a tenant or something, that they're going to fall over. They actually have the buffers in there to make it safer and to lower their risks this time around.
Yeah, the banks are definitely certainly helping with that narrative, but it's good that they're being very cautious themselves, but it is enabling the investor to carry on. But with the less risk, you're not seeing the 110% mortgages they were giving out back in 2006 and 7. I forget what they were called.
Look, lenders were let's say imprudent last time around, and I think they're not going to go and say that too openly, but some of their practices weren't particularly sensible, and it's around like 110% loans, and they're doing higher risk low doc loans at standard rates, so they weren't actually pricing in the risk of the deals. Now they are actually pricing in risk, although I'm not sure that pricing in risk around LVRs is actually the right way to do it. And I say that because there isn't any evidence to say that people with low equity in a deal are more likely to fall over than others. The whole issue is actually around whether the borrower can actually service that loan, and it doesn't matter what their LVR rate is. It's all around serviceability, and I think that's where the Reserve Bank LVR restrictions are wrong. I think it's just too crude a tool, but banks are being a lot more cautious and prudent and sensible in terms of their lending decisions now.
Yeah, definitely. And one of the other, I've dealt. In fact, people have come to me in the past because we've dealt all around New Zealand, not just the main cities. And I saw a very good article I refer to all the time in the your issue. I'm not sure if it was about the October or November or the December issue. It was in the magazine, and it had the map of the North Island and the South Island of people migrating in and out of the areas. And we've had some pluses for, like, if it's had a 5% growth or then 10% growth or 25% growth or whatever it was. And I think around New Zealand now, some areas are hurting out there. I think if you go to one of those areas where the inflow of people was that 5% or better, and I've referred to that map quite often, that's with a property cycle, it's a again, cautious, but I think it's a safe investment in any of those areas in the country. There's a lot of investors I talk to all the time. Time's the healer if you buying and holding. If you're buying in one of those areas that are going forward, even if it's going forward slightly or going forward greatly, that's certainly the places to make your investing a little bit safer.
Yeah, two of the key messages I often talk about are, one is I get frustrated with the mainstream media, how they talk about the housing market as just one big market, which is the same everywhere. The housing market in New Zealand, like in any other country, is made up of lots and lots of micro markets. And when the media go and talk about, the housing market is just one big amorphous mess, I get frustrated because I just
Not
think
the only one.
I just think it's misleading and it doesn't help readers, and particularly in New Zealand at the moment, where you have two, the two biggest cities, Auckland and Christchurch, are going through certainly some sort of stress. And while the Prime Minister might not call it a crisis, I think to a lot of people, it probably is a crisis. But you come to places like, Rotorua or Palmerston North or Invercargill or wherever, they're totally different markets. The other key message that I take out, or I talk to readers about, or property investors about, is, most people invest in their local markets. It's not 100%, and again, Rotorua, where we're based, is a great example because we have a lot of out of town investors. But for a lot of people, and probably the majority of investors, they actually invest in their local markets, and so it's really important to understand the markets you're investing in and what drives those local economies. And I think it's having a good understanding of the local market is actually quite critical, so the areas to go to and what's happening there. And that's why we do the regional reviews in the magazine, where each month we go somewhere new and we find out about it. There's absolutely nothing wrong with going and investing in areas outside of where you live, and that's fine, and often it's actually a really sensible thing to do. But if you do that, it's also useful to understand sometimes what's happening in those markets.
That's great. So yeah, just moving on. Just so I'm going to go back to a little bit to the start. What you said, we're sort of giving some really good tips of how you see things and I see things with the market at the moment. Just thought I'd go back to one early point you said about for the personal investor regarding building your own portfolio, not just through property or what have you. And the diversity was a big word you used. Do you just want to touch a little bit more about that again, just to emphasise how, and it's only one man's opinion who's been in the game for a long time, mind you, but I think that'll just help, especially some of the newer investors of, you have to make a start somewhere, so specialise in that area, and this we talked about property here now, but it is not the only thing, and and the reasons why.
Oh, from my perspective, and it's the philosophy I have both at a personal level and a business level, is you have to have some diversification in what you do. On a personal level, wealth creation to me is about having your own business. It's about property. It's about shares, and it's about making sure you actually have some diversity across your investments. And property, I think, and property is it's the same, so that's in the business, and it's the same in terms of with your personal investment. So having diversity in what you do is important. But property is great, and property has been the source of a lot of wealth for many people, and a lot of the people, we read about, who are the successful millionaires, etc. Their wealth was built around property. There's no doubt, that it's a great asset class to be in, and there's lots of different ways you can do it. At the end of the day, I guess it's as simple as the fact that everyone's got to have a roof over their head, so it's going to be a product or a service, as I call it, that is always going to be around, and is one that you should get involved in.
Yeah, and I know a few investors who they do exactly what you do. They are diverse. They've got their Kiwi Bank going away and other investments just sort of sitting there going away. Sometimes the share market, if they know the market well or informed well, they'll take it out there and put into property sometimes. And then if you have the ability to do both of them and you're knowledgeable in both, you can actually play that around to really increase your wealth.
It's interesting with shares. If you want to do shares directly, it's bloody difficult to do. Um, you know, you know, trust me. um, you know, shares are actually incredibly complicated, and they require. It's sort of to me, direct share investing actually requires some day-to-day involvement. Well, property isn't day-to-day involvement. But there's different ways to do shares. I mean, having your shares held through your KiwiSaver, and using a reputable manager there is actually probably the most sensible option for the large majority of New Zealanders. I don't think there's a lot of property investors who would be active direct share market investors, and I wouldn't expect that, because I just you'd nearly have to be a professional investor to do that. But own some shares, but probably suggest using either managed funds or KiwiSaver, which is essentially a managed fund, to do it, is the sensible option. And having managed funds which aren't part of KiwiSaver have some merit in the sense that you're not locked in there till age 65 like you are with KiwiSaver. So if you have KiwiSaver, you could actually have maybe a little bit in some other managed funds somewhere, so if you actually need them, you have some instant liquidity to it. But it's about having diversification, and being prudent in what you do.
Yeah, but life's all about having options, and if you have various investment tools, you have options. And as we discussed earlier, one good thing with property is you can, within reason, control or add what you want to any property you own.
Oh, look, just to reiterate that point, I mean, one of the beauties about property is that it is probably the only asset class where you can take control of it and you can add value to that investment yourself. You can't do it with shares and bonds and other things, but with property, if you decide to add a room or do a renovation or do a subdivision or whatever, there's lots of different value add opportunities which you can do, and that's one of the great things about property.
Great. So someone, you sort of said before, if someone has a story about property or they think it'd be something you'd be interested in, and you said contact you, who do they, probably you don't want to give your email out, but maybe your staff, so how do they contact you to do that?
Oh, look, they're quite happy for them to contact me. Just philip@propertyinvestor.co.nz. I'm fine. I mean, the email address is out there and all around the place, so anyone can find it. And always happy to hear from any of your listeners.
And just actually another, I suppose we plug for the landlords.co.nz. Investors are listening to us, they want to know how to find properties, and of course they can find them at our website, Property Ventures. But you have investment gems, part on your page too, amongst all the wealth of information and blogs and stuff you have on there.
Yeah, look, Investment Gems was built up out of, there's lots of big sites like TradeMe and realestate.co.nz. We wanted to have a listing of properties which were suitable for investors. So if you're looking to buy an investment property, you can come in there and you can look and all the properties which sit there, they meet some sort of investment criteria. Obviously a lot of your stuff in there is very good as well. And so people can either just go directly to your site or they can come into landlords.co.nz and see others as well. So it's a great place for people to go looking for properties. And, often one of the hardest things is actually finding the time to go and do find the right property. So the services that, Property Ventures provide is really critical, or really is a great tool for investors, particularly if they are a bit short on time.
We're finding more and more that people say to us, it wasn't the Kiwi way 10 years ago, I don't think, but people are more than happy to save time now, pay us our fee to find them the properties they want. And as we're getting bigger and as your database is bigger than ours, people don't want the same old thing. They want different things. They want a development, or they want a bit of land, or they just want cash flow or apartments. So the good thing about what we're trying to provide now, and Investment Gems do, they provide different options to the investor.
Oh, absolutely. And I think the services there are great. And now there's, fantastic information about, the properties, and I enjoy going and looking out there and seeing what's out there and saying, oh, that one looks pretty good.
Yeah. Oh, good. Okay. Well, before we sort of wrap up, is there anything else you want to discuss there, Philip, or tell the listeners about?
Oh, no, I just wish, everyone's success with their property investing. I think people who get into property investing end up enjoying what they're doing, and it can be a really rewarding asset class to get involved in. And just remember, be safe and sensible out there and don't take on too much risk.
Definitely, wise words. So thanks so much for your time, Philip, and who've enjoyed the last 50 minutes.
Yeah, no, it's been great. I've really enjoyed it. Thank you.
I would like to thank Philip for his time, and I'm sure you have all found it extremely interesting. If you have enjoyed the show, we would appreciate it if you went to iTunes and put your honest review in the customer review area. Have a great day.